If I were diving into tax planning today as a small business owner from scratch, this is the game plan I'd follow. And guess what? That's exactly what I'm unpacking today. We've got a lineup of real questions from listeners and viewers just like you. From strategies to someone making $1 million or more, to making sense of short-term rental deductions, and to the ripple effects of the one big beautiful bill. Have a question that you want answered live? Head to taxsavingspodcast.com, click on podcast, scroll down, and drop your question there. Now, let's dig into the incredible questions that we received from followers. The first question we have is from a random listener, and they said, "Hello, love the show, and I can relate to being a person that learns about strategies, but never implements them. This leads to my question. I just listened to the latest episode about tax planning, and it made me curious if there is some sort of hierarchy for small business tax planning strategies." And they said, like with retirement savings, you start with employer match, then fill up various retirement saving buckets like an HSA, IRA, 401k, brokerage, etc. And then they also mentioned in the FI community, they talk about how you should start with addressing the big three costs: housing, food, and transportation, because those get the most bang for your buck. Does something like that exist for tax planning? And that's a great question. And when I talk about tax strategies, I tend to break them into two categories: core tax strategies and advanced tax strategies. Now, core strategies are available to business owners of all sizes. They're relatively easy to implement. There's no additional cost to implement them. They're relatively easy to understand. And that's what I call core tax strategies. So whether you're making $10,000 a year or $10 million a year, we can implement core tax strategies. And I always say we always want to fully implement to the highest extent all of the core strategies before we ever look into what I call advanced type strategies. So core strategies come first, advanced strategies come second. Core strategies are things like hiring your kids, the home office deduction, having the right entity structure. And a lot of core tax strategies formulate around this idea of maximizing deductions that I talk about a lot. And the concept behind maximizing deductions is not going out and buying things that you don't need. The core concept around maximizing deductions is taking spending that you're already doing and finding a business purpose for it and turning that spending from after-tax spending that you just do with money that's already been taxed, to finding a business purpose, moving it into a business expense, and now turning that after-tax spending into pre-tax spending. And that is a really core concept to a lot of different strategies in various different areas. So whether it's meals and travel and board meetings and those types of things, or it's as simply as hiring your kids. You know, as a father, I know that we're always supporting our kids, but if we can find something that our kids can do in our business, now we might be able to get a business deduction for those items, and then they go out and pay for their basketball camps and they're going to amusement parks with friends. And from that standpoint, we just turned a typical after-tax spending item into a pre-tax spending item. So it's taking spending that we knew we were going to do anyways, but finding a business purpose for it. So that's a lot of what core tax strategies stem from. We always want to exploit and implement core strategies to as much as possible. And if we still have income, around the $350,000, $400,000 or more range, that's when we start to dig into advanced strategies. And advanced strategies can get complex, can get a little bit more harder to understand, and typically be reserved for those higher income earners, because sometimes there's an investment involved with them, or there's some type of legal cost involved with them. So yes, there is a hierarchy. I say core tax strategies first. Once we've fully implemented those, then we go to the advanced type tax strategies. So hopefully that helps and gives you some idea. We talk a lot on our YouTube channel, our podcast, about core strategies. We really deep dive into those. All right, the next question is from Shannon, and she said, "Can you do an episode on the big beautiful bill and the implications of it to small business owners?" Yes, Shannon, we did an episode on July 9th that we broke down kind of the main key points of the big beautiful bill. Although it's a big bill, the tax piece of it isn't that big. You know, it's not a huge part. A lot of it is just extending what was already done in the Tax Cuts and Jobs Act and just extending it or making things permanent. But we did an episode on July 9th on that, and we're going to have continuous updates as we start to continually unpack this, as we get some clarification from the government on certain different things that are part of the bill. We're going to unpack it. We're going to keep you updated. So subscribe, follow, like, wherever you tune into us, go there and make sure you continue to follow us for updates, as we will just continue to talk about some of the items in the big beautiful bill. But check out that episode from July 9th where we deep dove into it. All right, we have a question from an anonymous Facebook group member. And if you're not part of our Facebook group, go there now. Go to Facebook, type in Small Business Tax Secrets, join, and ask your questions in there and join with other small business owners. But this question was from an anonymous Facebook group member, and they said, "Hi, I need expertise from this great community. As we all know, the big beautiful bill passed with all these various different items, and they talked about the $500,000 limit for the QB, for the SALT deduction, and then a QBI deduction that starts to phase out. And they said they're trying to take advantage of both the QBI deduction and the SALT deduction, but their income is going to be $1 million this year. And they said, I've already maxed out the mega backdoor Roth, the defined benefit plan, Section 179, accelerated depreciation, and real estate professional status on their rentals. What other strategies can I implement to bring my AGI below the phase-out income levels and also avoid the alternative minimum tax, the AMT?" So this is a great question, something we talk about and deal with every single day in TaxElm. And there is a lot of planning around phase-outs. Because not only if you can lower your income below a phase out, it opens up the door to a bigger deduction, and it can provide some massive tax savings. And based on the income level that you're at, you're $1 million, you're looking to get around that $500,000 or even lower range. And what are some of the strategies available to you? For those, if we've already implemented everything that we can in core tax strategies, now we want to dig into advanced type tax strategies. And we talk about all this in TaxElm. We guide people through this. We do training on it. We have fully implementation modules on all these different strategies. But if we've fully implemented core strategies, now we start to look at advanced strategies. And in our advanced strategies, we look at asset purchase strategies. We look at asset donation strategies, oil and gas investments. Maybe we might look at captive insurance. And in each of these types of categories, asset purchase, asset donation, oil and gas, captive, we have multiple different options, different programs, different partners. And all of these types of strategies would be a great opportunity to move you from $1 million of income to $500,000 of income or less to bring you into some of those phase out ranges. So these are all strategies that we look at. We can't cover them all in a Q&A episode, but definitely check out TaxElm. We talk about and work with business owners on these on a daily basis. But again, let's fully implement core tax strategies first. Once we've done that, then we start to deep dive into these advanced strategies. And typically these are going to be reserved for those making $350,000 or more. And again, we're looking at various different partners and programs and things that we have on an asset purchase strategies. Some of this involves solar, some of this involves equipment, some of this involves software. We look at asset donation strategies, oil and gas investments, captive insurance, many different directions and angles we can go. It just depends on kind of what your situation is, what you feel comfortable with, what we want to look to help lower that type of income. So definitely check out those items. Next, we have a question from another anonymous Facebook group member, and they said, "My husband and I own a few businesses, S-Corps, and would like to take advantage of the short-term rental 100% deduction thing in the new tax bill. I understand that in order to qualify as a rental as active, not passive, and therefore count against non-passive income, we have to spend at least 500 hours working on the property and maybe a few other things, but that's the biggie. My question is, can this deduction offset our business income that flows to us as individuals since we are an S corporation? From what I can tell, this will offset W-2 income and 1099 income, but is it the same for a small business owner?" So a few things in this question. One, if you own multiple businesses and have multiple S corporations, check out our training that we did. We typically like an entity structure where you only have one S corporation, and then your ownership in other entities are owned by that S corporation. So you have one S corporation instead of multiple that flow through you, but that's not related to your question. The second piece to your question was the short-term rental 100% deduction thing in the new tax bill. And what I think you're referring to is bonus depreciation, where bonus depreciation has been bumped to 100%. The one thing I want to make clear is that when we're looking at real estate, it doesn't mean that the full purchase price of that real estate, that property, is at 100% deduction. You can only bonus depreciate a property that is a shorter life cycle of it. So typically we say rough back of the napkin numbers, roughly 30% of a building cost can be deducted in year one utilizing bonus depreciation, and the rest would be spread out over 27 and a half years or 39 years depending on the type of activity that you have. So that's just one thing I just want to make that clear, that if you buy a building worth $500,000, you don't get a $500,000 deduction today. If you do a cost seg study, we can separate that building from the main building pieces and then items that get depreciated quicker, and we can move a portion of that $500,000 in bonus depreciate it and get that all in year one, but it's not going to be that full 100%. So just keep that in mind. The next thing that you mentioned was the 500-hour rule, and maybe 750 hours is another rule that we might be looking at. And what you're specifically referring to there is the real estate professional status. Now, you're talking about short-term rentals, which is different than real estate professional. They have completely different qualifications on what you need to do in order to have it offset your W-2 income, your business income. So when we look at a short-term rental, we don't even have to worry about that 500 rule or the 750-hour rule. That's real estate professional. That would be if you have a long-term rental that you're looking to offset some of your active income with. But if you're looking at a short-term rental, this would be an average rental stay of 7 days or less. We only need to materially participate in that rental. And that's 100 hours that we'd have to put into that rental. Now there's a couple different tests, but the main test that we typically see is that you put 100 hours into that short-term rental, and that's more time than anyone else spends in that short-term rental. And if we do that, then losses from that short-term rental can be used to offset W-2 income, business income. Again, it's not going to be the full purchase price. We're going to be able to do a cost seg study on that on that short-term rental, and we're going to take a portion of that building value and deduct it all in year one. But it's usually about 30% of that building value that we are able to take bonus depreciation on and get that full deduction in year one now because of the one big beautiful bill. So just some clarification items in that question. And then what you mentioned is W-2 income, 1099 income. S-Corp income would be classified in that same thing. So if you qualify for the short-term rental and if you have losses from that short-term rental, you can utilize that to offset W-2 income, 1099 income, S-Corp income, all of that would be included in it. But just some clarification on some of those items that you mentioned there. Now, real quick, if you're a business owner, there's a good chance that you're overpaying in taxes by a lot. And that's why I built TaxElm. Imagine having a team of tax experts on call. Imagine having a tax blueprint showing you exactly what strategies apply to your situation, as well as tools to implement those strategies step by step. The best part, if we can't save you more than your membership cost, you get your money back. No questions asked. That's why TaxElm is a no-brainer for business owners who want to keep more of what they earn. Click the link in the description to book a free discovery now. All right, now back to some listener questions. We have a question from Rex, and he says, are there any tax advantages to a trucker being paid as a 1099? And Rex, absolutely. That's what we talk about every single day. And the cool thing is that as a 1099 worker, you are now a business owner. And guess what? The government gives special advantages, special incentives to business owners that they don't give to W-2 employees. Why? Because the government wants people to be business owners. Business owners help build up the economy. Business owners hire people, and the government likes people to be hired. They like their citizens to be hired. And so for all those different reasons, the government incentivizes business owners through the tax code to take advantage of different tax strategies. So as a 1099 worker, you're going to have sales or revenue or your 1099 income, and then you're going to be able to take expenses that help offset that. And so we look at a ton of core different tax strategies that create expenses that can offset that 1099 income, and then you're going to have a profit. And that profit is what you're going to be taxed on. So very rarely would you have a 1099 that say your 1099 is $100,000. Very rarely would you also have a profit of $100,000. That wouldn't make sense. You'd always have expenses associated with that if you're learning tax strategies and implementing them. So Rex, you're in the right place. Tune in to our podcast. Check out previous episodes. Check out TaxElm. These are all different resources that we have to help business owners exactly in your situation understand what strategies are available to them and what they need to implement to help lower their income as much as legally possible. And a 1099 contractor is in a great opportunity to do that. Our next question is from an anonymous Facebook group member, and they said, my business has grown and I will likely be left with $2 million in profit in my S corporation. The building my business is located within is owned by my wife's real estate LLC, and they talked with someone that felt like they could use this to the advantage against taxes somehow. Right, so what you're thinking about is what we call a self-rental, where if you have a building that your business operates out of and both your business and the building have similar ownership, we can do a -4 election where we can take losses from that building, utilizing a cost segregation study, and those losses can be used to offset that business income. So check out a -4 election that we talk about there. The next thing they said is they talked with someone that said that their S-Corp can finance expensive equipment, not even used by their business, and that a rental company will pay the monthly payments and then buy the equipment from them after a period of time. The financed equipment can then be used as a tax deduction. Does this make sense? Does anyone have any experience with the CPA, tax attorney teams working together to reduce your business taxes to zero? So, and I'm going to say something, remember, that's exactly what we do at TaxElm. We first start with core tax strategies, implement those as much as possible, and then we take that step to advanced tax strategies. So like we talked about earlier, some of the advanced strategies we have are asset purchase strategies, and utilizing equipment might be one of those different strategies. We have many different routes, different partners, different programs that we can do inside this one strategy of asset purchase strategies. We have asset donation strategies, oil and gas investments, captive insurance. All of these would be viable options that can help significantly reduce your income, sometimes to zero, or at least a significant reduction in your income. So check out TaxElm. We work with business owners just like you every day, looking at advanced strategies, building out plans to help lower that tax liability, and you would be a great candidate for a lot of those advanced tax strategies. But again, before we go to advanced strategies, we want to make sure that we're fully taking advantage of all the core tax strategies that are available to us. Then we have a question from Rex again, and he said, quick question, if anyone can help. I know that the owner of an S corporation who works in the regular operation of the business must pay themselves a reasonable salary. But what if they decide to reduce that salary due to a decrease in business revenue? Is it likely that they will have an issue with the IRS? And so Rex, when the IRS looks at a reasonable salary, they look at the distributions, the money that you're taking out of the business, and how does that correspond to your salary. So the most that the IRS could ever do is take distributions and say, you didn't take a big enough salary, so we're going to move distributions and move them into a salary piece. But if your business decrease, which likely means you're working less, which would mean that you would take a less of a reasonable salary. So nothing to worry about there, as long as you have documentation on why your salary is reasonable. What are you basing that off of? Whether it's hours, whether it's the type of work you're doing, make sure you have documentation of that reasonable salary. But don't worry if that fluctuates based on how business is operating. That is a very typical practice. So keep that in mind, Rex. Next, we have a question from Stacie, and she said, we just started an LLC this year. I'm keeping track of all of our expenses, and I'm not sure if I should do the simplified or regular method of our home office. I know the simplified method is capped at $1,500, but is the regular method the same? So the regular method, or the actual method of the home office deduction, is not capped at $1,500. It would be whatever your total home costs, associated costs are, times your business use percentage. So what part of that home, how much of that home is business related, find that percentage and then take all of your costs, and that's going to be your business deduction. So it's not capped at the $1,500. Stacie, what we typically do, and within TaxElm, we have a worksheet that lets you calculate both options and just tells you what's going to give you the best benefit. So do the math, do the calculation. If the actual method's going to get you $1,600 and the simplified method's going to get you $1,500 deduction, maybe you just go for the simplified method just out of easiness. But typically the actual method, generally stating, is going to provide a better benefit than the simplified method. The next question we have is from Sean, and he said, I've been trying to figure this out for a while now and keep getting different answers from different professionals. Here's the scenario. We have two LLC owners, taxes and S corporation, and they want to take advantage of many of the tax strategies discussed in this program, but find it difficult because of the nature of distributions from the S corp. The problem is they have unequal ownership percentage and unequal planning opportunities. One has kids, one doesn't. One pays more in SALT, etc. The reconciliation work to adjust the distributions to match the ownership percentage and utilize these strategies would be difficult to impossible. So, and then they have a bunch of different activity here. So Sean, we talk about this all the time. We help business owners walk through this every single day. We also did a couple podcasts, YouTube videos on this strategy, but typically what we're going to recommend is that main company that has a partnership is going to be an LLC partnership. So instead of an S corp, it's going to be an LLC partnership, and the two owners are going to own their percentage of that LLC partnership via their own personal S corporation. And so what that means then is that they can do all of the planning inside of their S corporations without affecting the other partner. So let's say you have a partnership that has $200,000 of income, and let's say it's 50-50 partners. That means that each S corp is going to get $100,000 of income, and then inside those S corporations, they're going to do their different planning, hiring their kids, automobile, board setup, all those different things they're going to do inside each of those S corporations, and that's going to be separate from the partnership. So that is our favorite structure. We talk about it. We go into detail of what this looks like, especially if not only if you have partners, but if you have multiple businesses, what that typically looks like. So definitely check out some of those other items that we did on that. But again, typically we're looking at when you have a partnership, we're going to have an LLC partnership And then the owners in that partnership are going to be the S corporations, and that S corporation is going to be owned individually by one of the partners. All right, we have last question. We have a question from Jake, and he says, my business profits $75,000 a year prior to paying himself, and he W-2s himself $50,000 as an employee. That leaves actual business profits of $25,000. He says, how do I access that other $25,000? Do I just have to find a creative way to make the items I want to use on it tax deferred? Are there any other ways to access that without simply increasing my W-2? Jake, great question. And I'm assuming that you're an S corporation here because you're taking a reasonable salary. And so with an S corporation, we actually split our income into two pieces. You have a W-2, which is that reasonable salary, that's $50,000 that you're talking about. And then you have distributions or draws. And so that remaining $25,000, you would just take as a distribution or a draw. And that's as simple as moving it from your business account to your personal account. Now, it's not going to be a deduction to the business because it's a draw account. That's a balance sheet item. It doesn't reduce income, but that's how you take that money out. It's an owner's draw. It shows up on the balance sheet. You just move that money from the business account to your personal account. Now, for your situation, when we talk about an S corporation, we need to make sure that we're taking a reasonable salary. So it's got to be high enough to be reasonable, but we don't want to take too much. And so you might want to do an analysis to make sure that your salary is the right fit. Typically, we say a rough back of the napkin idea is about 50% of your income you take as a salary, and the other 50% you take as a distribution or a draw. So let's say you were making $100,000 in your business, you would take $50,000 as W-2 salary to yourself as the owner, and then the other $50,000 that's left in there, you take as an owner's draw. You transfer it from your business account to your personal account, take it as an owner's draw. So Jake, hopefully that was helpful. Definitely look into that, but yeah, that's how you pull it out. Now, of course, we want to take expenses and all that before we even work on that, but you wouldn't want to just spend that money and things that you don't need. Just take it as an owner's draw and transfer it from the business account to your personal account. So we covered a lot today, from tax deduction hierarchies to real estate loopholes and how do you handle $2 million in S-Corp profits. And if your head is spinning in a good way, make sure to re-listen, take notes, and most importantly, implement these tax strategies. Got a follow-up question of your own? Don't sit on it. Go to taxsavingsPodcast.com, click podcast, scroll down to the bottom and submit your question. It might just be in the next episode. And if you found this helpful, don't forget to subscribe, hit that like button, and share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax professionals implementing these strategies that we talked about today, along with many other tax strategies, visit taxelm.com, that's TaxElm.com, or click the link in the description for a free discovery call. We're helping people like you legally lower your tax bill every single day. Thanks for watching, and I'll see you on the next one.